Subscribe to our YouTube channel and press the bell icon to get the latest updates.
In today's video, we're going to be talking about a pharma company, and I'm going to briefly touch upon some details of the company, about its dividend, which by the way is great especially for a pharma company, and I'm going to tell you why I think that instead of the relatively more popular names out there in pharma that are more in the limelight, this stock could be the dark horse to watch out for. Hi everyone, this is Yazad and I'm so glad that you could join me today. In 2020, when the pandemic hit the world, pharma companies boomed with many stocks trading at their lifetime highs. However, the sector has corrected by close to 16% since its highs in September 2021, as pharmaceutical companies were impacted by raw material availability, leading to sustained higher input prices. Now, with a lot of pharma companies currently trading close to their yearly lows, some experts believe that this may be a good time to revisit the space. Given the fact that healthcare is a necessity, demand for healthcare products and services will always remain regardless of the economy. Now, pharma stocks are a combination of both growth and value, which makes them one of the very few available equity investment choices that offer returns along with stability. But which pharma companies should one look at? When we think of pharma stocks, some of the most common names that come to mind are Sun Pharma, Lupin Pharma, Cipla, or perhaps even Dr. Reddy's Lab. Often, there are other overlooked stocks which are hidden gems that most people simply ignore. In today's video, let us look at one such pharma stock that investors must add to their watch list. Sanofi India Limited is the Indian subsidiary of France-based pharma multinational Sanofi SA. Sanofi SA is a French multinational pharmaceutical giant and the 9th largest pharmaceutical company in the world by revenue. With 100,000 plus employees, the company provides healthcare solutions in over 170 countries. Here's why you should consider adding Sanofi India Limited to your watch list. The company has been present in India since 1956 and is focused on the chronic disease segment. Sanofi has a leadership position in anti-diabetic therapy market. It has a presence in therapy areas such as diabetology, that's insulin and oral, cardiology, allergy and vitamins, pain management, thrombosis and central nervous system. Because Sanofi caters to the chronic segment, this ensures regular demand and clear visibility for growth. Sanofi enjoys premium pricing in key products versus competitors. The company is focused on the domestic markets with over 80% of revenues from it. 4 of its products feature among India's top 100 pharma brands: Lantus, which is for insulin diabetes, Allegra, an anti-allergic, Combiflam for pain relief, and Amaryl, again a diabetes drug. Revenues have been impacted due to the sale of their Ankleshwar unit, but the company has been able to cut costs and improve margins. This is in line with the strategy to primarily focus on the domestic market going forward. The PE of 14.8 and a price-to-book ratio at 6.8 seem to be at reasonable levels. The company has very healthy liquidity ratios and the enterprise value is higher than the market cap, which could indicate that the stock is undervalued. However, that doesn't give a clear picture and should always be looked at with other metrics. Sanofi's dividend payout has grown consistently over the years, as is visible from the table above. The company has mentioned that it will announce a special dividend very shortly. From its high of 9,300 in August last year, the stock has been in a gradual decline and currently trades near its 52-week low. As per the June shareholding pattern, the promoters hold 60% stake, while large hands like mutual funds, FPIs, and insurance companies hold a combined 27%, which leaves only around 12% with small players. Sanofi India has aligned itself with India's healthcare needs by building expertise, capability, and capacity through continued investments, strategic partnerships, and a shared commitment towards patients. Post the sale of the Ankleshwar plant, Sanofi has been focused on three areas: accelerating growth in the diabetology space, fortifying presence in established brands, and focusing on building brands in consumer products. The company has made a shift towards the lucrative branded formulations business in the domestic markets with an aim to improve margins. The Indian pharmaceutical market is expected to grow due to factors such as improved healthcare access, awareness and diagnosis around non-communicable diseases, and government interventions to expand healthcare infrastructure. The demand for medicines for most chronic therapies like diabetes and cardiovascular treatments is relatively stable, which is expected to maintain steady revenue growth and strong margins in India. Sanofi has high visibility for growth from domestic markets, a robust cash-rich balance sheet, minimal capex, and a healthy cash position. Now, this coupled with new launches, brand extensions, and access to innovative molecules from the parent could also contribute to Sanofi's growth. The product development and R&D costs is borne by the parent Sanofi SA, with almost nil costs towards R&D expenses for Sanofi India, resulting in consistent free cash flow generation. On the downside, key risks to growth include addition of any of Sanofi's products to the national list of essential medicines, which may adversely impact the overall performance. Further, there is high concentration risk as majority of revenues are generated among the company's top 10 brands. Global demographics continue to shift, and with this, healthcare needs. As life expectancy increases, for example, so does the demand for healthcare services. An aging population will require long-term care for complex health issues. Furthermore, unhealthy changes in lifestyle will increase the prevalence of obesity and other chronic health conditions. Sanofi India, being a leading player in this segment, looks well set to capitalize on it over the next coming years. That's all for this week. Thank you very much for watching. Like always, remember that the purpose of these videos is to only share ideas, and none of these are in any way any recommendations. Until next time, goodbye.